Welcome, everyone, to Name Confidential Live.
Hi, everyone. Welcome to this week's episode of Name Confidential. My name is Asher Rogovy. Today we have Tang from Arch Indices, an applied AI company that's launched one ETF with some others on the way. Yang, welcome.
Hi, thank you so much for having me.
Thanks for coming. Let's get started as always with the name exposure index. I'll pull that up here. This week's index came around 90%. As a reminder, that's a survey of our members who on average have, or in aggregate, have a 90% exposure to equities in their portfolios. It's a pretty strong reading. A lot of people trying to capture that upside. Up slightly from the last quarter average of 80, ticked up from last week of around 87. These are pretty healthy levels in the market. It looks like we've been kind of trending up for about 2 months after some maybe scares with the rate cut. Yang, how do you read this and what you're seeing in the markets week to week in terms of exposure?
Yeah, this actually makes a lot of sense to me that, people have increased exposure over the last few weeks. I think, going into the summer, we saw a lot of people de-risk, especially as, the employment numbers, the jolts came in softer. So I think, with now the rate cut and kind of employment numbers coming in a bit healthier, right? And, the tail risk of a hard landing off the table, it makes a lot of sense that, people have been looking to increase exposure. We've had a number of those conversations with advisors and investors and family offices about, what's the right exposure level here. And I think the general consensus probably over the last, few weeks was people are a little bit underallocated relative to where they wanted to be.
Makes sense, yeah. So it looks like our index is a great coincident index of how our members' portfolios are allocated, and I guess how the rest of the market is as well. Great. So let's talk about you and your company. Yang, tell us about your company.
Sure, I'd love to. So we founded Arch in 2022. Arch is really an applied AI company. So we don't use generative AI, but rather we use optimization and machine learning techniques to build portfolios. So our approach really is goal-oriented. We want to reach a goal and minimize volatility of the portfolio along the way. So the question that we're solving for is, what is the composition of securities in a portfolio that best meets that goal, right? How do I construct this portfolio that is A, getting the goal or the exposure that I want, and B, has the least amount of portfolio volatility? So we employ something called an optimization approach. And the idea is, it kind of goes back to modern portfolio theory, but the idea is you're looking for the efficient frontier of what you want to do.
But it's not just kind of like a static allocation, right? Things change around, variables change, and I feel like a lot of people with that efficient frontier modern portfolio theory approach kind of use historical returns that assume don't change. So how are you dynamic, and actually how are you actively managing your holdings?
Yeah, so that's a great point. The modern portfolio theory is, after all, just a theory. It doesn't actually work in practice, right? That's just how it is. Okay, so the modern portfolio theory has actually quite a few flaws. The first is, it expects someone to be able to predict future returns. I think that's, even if you're the best forecaster on this planet, predicting the future is an extremely difficult endeavor. So instead of looking for, an expected return, right, you're looking for what is a factor or what is the exposure that you want. And we can use our ETF VWI as a kind of a case study as we talk through it. So VWI's goal is really to generate income. So instead of using expected returns, we have observable yields. So that is the factor you're optimizing. The second is, yes, every portfolio. So the moment you build an optimal portfolio, the next second, right, it's no longer quote unquote optimal. It's now changed, right? The market condition changed. Maybe S&P went up a little bit, the bond market went up a little bit. So now your portfolio is out of sync. But in reality, does it really matter? No, right? Like you're not going to rebalance your portfolio every second. So the question comes down to is at what point does it make sense to rebalance? For us, it's every quarter. We've run some empirical studies. You probably want to rebalance at least once a year, but you probably don't want to rebalance more than say, monthly at best.
Right, you want to let your winners run.
Yep.
But I've seen you showed me your allocations since you've launched the fund, and you've had some pretty big swings in various asset classes. So to me, this reminds me of like a sector rotation model. So are you achieving sector rotation simply through this optimization process?
Yes, it's funny. We actually do, and maybe I take a step back and talk about how our product works. So and I think many people that have income strategies, you kind of get the game that picking something with the highest possible yield generally doesn't yield the best result, right? If your portfolio is yielding 26%, you should probably ask yourself, why does my portfolio yield 26%? So the goal is, we don't target yield outright. We target something called performance ratio, which is the yield relative to the volatility. And volatility is, your first line of defense, right? Like minimal volatility is a well-studied factor. Generally, assets that, have less volatility do not have investor debate about the asset. So if you think about, a stock crashing, right? The stock doesn't go from 100 to 0 overnight. It starts dropping sharply, the volatility picks up, and at some point, it crashes and dies. But that didn't happen in like a step process. Same idea here is what you want to do is you want to stack kind of the two factors, right? You want the yield, and then you also want minimal volatility as the first line of defense. So you're looking for performance ratios. And in this case, when you think about sector rotation, right? The sector rotation is where do I want to be, assuming current market conditions, right? I want to generate total return, and implicitly, right, I want to reduce volatility, right? That's kind of how the idea of sector rotations work. So in this way, you kind of do the same, except instead of, doing total return, you're looking at income. So it's an income, I guess it's a dynamically rebalanced income sector is probably the right, way to think about it. And to your point, when we launched, we filed for the ETF, I want to say last June. At the time, it was very heavily exposed to actually tobacco stocks, right? And we know Philip Morris, is a great stock, if you're into the stock picking sector, had strong exposure to BTI, and it wasn't particularly bond heavy. So when you got into August, it got a little bit more tobacco-y, and starting like, in November, it dialed down back a little bit. It got into a little bit of financials. And then, the last two, the May and the August rebalances, the index got very defensive. So it got, it's over 50 something percent. It's 38% bond ETFs right now. And, it's another probably, I want to say 15, 16% in business development companies, which, really act as a bond ETF in many ways.
So I'm trying to add that up. You're maybe 50% exposed to income stocks right now?
Yeah. So the composition is usually it's pretty evenly split. I think there's a slight overweight on financials, but it's pretty evenly split across, the 11 sectors. And then, the bond ETFs and the BDCs have, the other 50% at the moment, which kind of makes sense, right? Because, when we rebalanced in August, the market actually was quite choppy. The S&P 493 up to August didn't really have a particularly interesting year by any figment of the imagination, and volatility was picking up. And the other observability was, correlation between stocks and bonds have been actually decreasing all year. So when you think about optimal portfolio construction, right, what you want is you want assets that don't move together. So the correlation is actually, a huge part of it. And the correlation decreasing this year actually drove, a big part of the volatility decrease of our ETF.
Great. So when you started out, so what was the sort of the maximal exposure to equities early on?
We put the index live back in May. We back tested it to 2018. I think maximum equity exposure, I want to say it's probably low 80s. It's never really gotten I want to say it's probably low 80s. Yeah, it's probably the right number. It's probably the max. Probably trend somewhere in the 60 to 80 range. Historically is where it's been. Right now it's kind of, the historical low, right? In August. And, that's probably a good decision in hindsight, given the market volatility we saw in August and, the good part of September. Right. So it's going to rebalance again next month in the beginning of November. So, we'll see how it shakes out. But, if I were a betting man, I'm guessing the equity allocation is going to go up a little bit from here.
Okay, cool. What are some of the challenges you found when building your model and also launching your fund?
Yeah, so our backgrounds really come from inside the investment bank. My partner is a PhD in math. So we worked on the structured solutions business inside, several large investment banks. So, a lot of it's actually funny, right? When people think about building products for, advisors, institutional channel, it actually varies quite a bit, especially when you get to more structured stuff. So the hard part was, I think for us, was building something that is, number one, does what it needs to do, at the right cost, right? Like, we can go nuts. We can hire, 200 PhDs to sit here and do nothing but machine learning all day, right? Is the investor truly served by that? I mean, maybe, but, it's a very expensive product to put out there. So it's really finding what's the right level of cost and benefit to the investor. And this, I think, our approach is actually one quite innovative in that we don't use a covariance matrix like, many of the other optimizers do. We actually built a kind of a recursive, learning process behind it. The second is, I think, launching a fund. I have a lot of opinions on this, but it's not an easy process for sure, right? You can go any number of ways of launching a fund. You can convert SMAs, right? You can launch a mutual fund. You can do an exchange traded fund. You can do a hedge fund. There's actually like any number of ways you can do it. We wanted to do an ETF model solely because, one, the ETF industry has been growing tremendously relative to other fund wrappers. And, there's an inherent, and the great thing about the ETF is there's an inherent tax advantage from the rebalances that we can get here that we wouldn't be able to get in certain other wrappers. So when you rebalance every quarter, right, the turnover rate, could be, 10, 20, 30%. You certainly don't, you want to optimize for the tax situation as well. So that was the huge appeal for us of the ETF wrapper. But yeah, certainly, I mean, I wouldn't say it's the hardest thing that, anyone's ever done, but it's certainly a process for sure. Meeting vendors, picking the right vendors, and as well as kind of the marketing, generating buzz, is very important as well.
Okay. As part of that marketing buzz, I know there's been a lot of articles about active ETFs. Are you kind of riding that wave yourself?
A little bit. Our ETF is pretty small right now. We the focus for us is kind of to organically grow some distribution channels. This is really targeted towards kind of, retirees, retirement portfolios, moderate allocation, conservative allocation types. We generally get traction with that crowd. Our core audience is really either a DIY investor doing some level of retirement planning and came across our product, or it's a, probably a, under 250 million independent advisor that, works on his own models, builds his own models. The active ETF thing, I think actually a lot of them are actually conversions or, they're new share classes of probably an existing product. There's been, of course, the tax advantage and also the increased accessibility of the ETF wrapper, right? Like buying a mutual fund is actually a little bit tedious. You got to fill out paperwork, you got to send money around, so forth, right? And you don't execute, right away. There's, a bit of a lag. You could be waiting like 1-2 days to get actually filled at the close or whenever the mutual fund trader rebalances. So I think the active ETF also gives, investors a bit of an intraday edge too, right? So if you see like a bit of a dip in the market and this is what you wanted to buy, maybe this is a good time to buy.
Cool. So you're starting with income. what other strategies or factors are you looking at?
Yeah, so we've been working on a couple. We've been working on one is value, and value has been a very and I went to Columbia Business School, so it's hard for me to say that value investing doesn't work, given that it has a pretty long track record. But at the same time, right, when you think about the U.S. economy has actually changed dramatically since the year 1980, right? Pre 1980, the U.S. was an industrial economy. So if you looked at price to book, price to earnings, that kind of made sense because you have large industrial pools of capital, and that's book value is important. Like post 1980, we've moved to an information economy. So the book value of Microsoft actually doesn't make one difference on people's view of Microsoft and its earnings power at all, right? In fact, most great companies actually have very low book value per se. So if you look at traditional value factors, right, price to earning, price to book, that's not really going to tell you, how investors think about a company. So we've been working on a couple. One is using free cash flow instead. So, you're looking for high free cash flowers, but also minimal volatility on top of that. I'm sure we all know companies that have like 10, 15, 20% free cash flow, but, some of them are kind of dicey companies. Some of them have, very challenged business models, but, perhaps are great investments because they also have low volatility as well too. So volatility is kind of your line of defense and in a lot of factor analysis. The other one is quality. We started looking at a couple things. ROI, return on equity, return on invested capital, a few ways, kind of reworking it a little bit. I think that one's a little bit harder in terms of quality, just because there's also a balance sheet factor, right? You could have very strong ROE, but if you're a way over levered balance sheet, that tends to be problematic for investors. So we're thinking about introducing kind of, a process where you're looking for below X% of industry peers. So, it's not fair to compare, say, an industrial company and a probably like a software company in terms of leverage, right? If there's a software company with high leverage, that's probably a little bit more dangerous than an industrial company with high leverage.
Right. Trying to think. I guess depending how you measure leverage,
Yep.
Maybe if you correct the capitalization of R&D expense,
Yep.
You can get them to be more comparable.
Yeah,
Right.
and
Yeah.
I was gonna say, also the retail, there's also accounting changes that impact this on like, over time, right? Because I think if you remember, maybe it was like a year or two ago, but they made a lot of the big retailers capitalize like their leases on balance sheet. So that led to a bit of an increase in retail leverage. But overall, like the business hasn't changed, right? It was actually an accounting rule change. So you also have to go back and normalize for like, when the accounting board decides to change a rule, you make sure that like, the previous data kind of matches up, all that.
Right. And software R&D expense is kind of high on my radar. And one thing you mentioned is book value. And I think one of the biggest problems with book value is that it doesn't get adjusted for inflation. Neither does the depreciation expense associated with it. So
yeah, and price to book is it's only really relevant for financial companies that mark to market or have a decent amount of mark to market, right? If you actually look at book value of banks that went under, they all had great book values. Just company didn't make it, right?
Right. I think insurance companies work too for book value.
Yeah, but outside of that, like if you were to go talk to an investor and you go, how do you feel about the book value of Microsoft? I mean, I think people just laugh you out the door.
Yeah, because of when did they start capitalizing R&D? Yeah. So you've launched with income, and you're most interested in value and quality next.
Yep.
What about growth, momentum, ESG? Any other, or maybe some uncommon factors?
Yeah, so we've been testing a few. This is actually an interesting factor. So one thing that we've been kind of experimenting with through a machine learning process is, what we call, I guess, positive beta skew. And the idea is simple, right? When the market is up or when the peer average is up, you actually want higher beta because that means the stock is outperforming. And when the market drops, you actually want lower beta. So you want the stocks that go up more on a big day, and you want stocks that go down less on a down day. This is, of course, a little bit hard to do in a kind of a optimization way. So we've actually running, a little bit of a machine learning process in the background, right? Is number one is, comparing to just the S&P 500 or, the Russell 1000 is somewhat misleading because, there's, like on days like, where people want Mag 7, right? The rest of the, sectors went down or the rest of the 493 went down. Does that mean the stock underperformed the S&P 500? Well, actually, yes. So are you going to punish it for that? Well, that may not be the best idea, right? Because if all, there's massive flows coming into the NASDAQ relative to, the Russell, right? People get impacted by that. So you almost have to do a little bit of a machine learning way is, which stocks, what correlate, what stock is this correlated to, right? So if you think of Visa, MasterCard, if there's one day where Visa comes out, there's the DOJ suing them and the stock drops a lot to MasterCard, right? That's probably where you want to punish it, right? Because that implies there's a problem with Visa. So, you always want the one of the two of them that's going up more on an up day, and you want to own the one that goes down less on a down day, right? So same with Home Depot and Lowe's, right? If Home Depot outperforms Lowe's 70% of the time, why do you own both? So you're trying to construct a basket around that is, how do you build some diversification in there? What other ways can you get out of this? So it's almost a momentum trend plus type strategy, but you're looking for, instead of moving averages or so forth, you're looking now for a positive beta skew.
So this is a third one you're working on?
Yeah, it's internally we call it Hive.
Hive?
Yeah, it's like high impact volatility exposure.
Nice.
Yeah, so it's kind of a kitschy name we came up with. We're testing in the background. We'll see where it lands. The thing about these things is, you have to constantly recalibrate a little bit, right? It's and then you're going to end up, if you think about statistical distributions, you're going to end up with actually a decent amount of noise in this process. So the question is, how do you refilter that either into something useful or do you ignore it? Because there are idiosyncratic events. For example, the DOJ the DOJ must be suing every great company right now, but the DOJ is suing Google, right? So it's well, how far back do you want to go on this, right? Do you want to look at Google on a 1-year period, 5-year period, 10-year period? At what point do you go, is this going to be a short-term strategy or is this going to be a long-term strategy?
Yeah, and maybe some of these events, if they're just white noise, a stock tanks on some news, it's actually a buying opportunity for a good long-term,
right.
Good long-term company.
Yeah, for the income ETF, we look at 12-month trailing volatility and the 12-month correlation factor. So we purposely don't go back more than a year because we rebalance quarterly. The problem is if you go back too long, right, you're not capturing changes fast enough. So if you're averaging, say, if there's one data point in, 250 days, right, that's an impactful data point. It's going to be 0.4%, right? It'll move 0.4%, But if you go back, say, 10 years, right, that goes 0.4%. So you can actually, if you go back too long, you can actually have a period where a company, is drastically underperforming, something bad happened, but, the model won't pick up enough because just 0.4% doesn't really matter that much in the grand scheme of a long-term model. So you're trying to decipher what's the right, capture today's impact, but also not lose sight of the long term.
Cool. So what do you see? What do you see about the looking forward in the markets and investing approaches? What do you see how do you see the future shaping up?
I think it's going to be a lot more AI, machine learning driven. And I don't think it's going to be quote unquote generative AI, right? At the end of the day, ChatGPT is, it's a glorified search tool. I think there's going to be a lot in terms of what you can do with statistical applications, machine learning, and even self-learning of portfolios. So, and that's going to enable people to build, I think, better portfolios with what they want, more customizable portfolios, and, get much better factor exposure. I mean, like we all know the S&P 500 is an active index, right? There's a closed door committee. They decide who goes in and who goes out. I mean, it's such a great committee that they allowed Tesla to be the eighth largest company in America before including it. So, great benchmark, right? But it is a marketing juggernaut. So that's what you're up against is, poor products that, are just marketing juggernauts. And I think over time with enough data and enough, machine learning behind it, investors have the tools, they'll be able to build their own better portfolios, more customizable, optimized for any number of factors, right? So for example, like, you and I are not at retirement age. So it doesn't make a whole lot of sense for us to be 100% generating current income, right? We want to probably minimize some taxes along the way and, look for things that could, exponentially grow until we hit the retirement age, right? When we hit retirement age, right, you don't want market volatility, you want income. Right, you got to replace income, you got to pay for lifestyle, so forth. So there's actually, I think, a lot of things you can do from that perspective of allowing investors to build even a better life path product. Allow investors to get more customizable, right? And people's risk tolerance is actually very different. I'm a very risk averse person at the end of the day. I actually want very little risk. Whereas, there are people I know that, basically treat their portfolio like a casino. So if you're going to take more risk, right, what's the optimal way to do it, within the framework?
Right. The market will treat you the way you treat it. You treat it like a casino, you're going to get casino results. You treat it like a bank account, you're going to get bank account results.
Yep. Right. But if you're going to treat it like a casino, though, right, there's probably an optimal way of treating it like a casino, and there's probably a suboptimal way. So the goal is you want to do it in an optimal way, right? I mean, if you just have a very high risk tolerance, and you want to YOLO on stuff, why not YOLO on good stuff? What makes sense statistically, rather than YOLOing on things that you read on a Reddit forum.
Or watched on CNBC. Cool. Do you have? Are there any quotes, investing quotes, or other quotes that you can apply to the markets that are meaningful to you?
Yeah, I mean, my favorite investing quote is always the Warren Buffett one. It's like, only when the tide goes out, do you discover who's swimming naked. That's really our approach here is, to be very defensive, right? You want to take risk, but you want to take smart risk. You want to do it in an optimal way, right? So at the end of the day, markets go down, right? There's no way we can build an investment product that doesn't have some chance of loss, right? Otherwise, it wouldn't be an investment product. It would be an FDIC insured bank account. So if you're going to be in an investment product, right, you want to be there. You want to, minimize your drawdowns. You want to minimize your volatility. You want to maximize your liquidity. You want to reach the goal. So, that's how I live my life is I want to make sure that, I'm not out there swimming naked when the tide goes out.
Right. Time to go back to shore, I guess, right?
Yep.
Yeah, I think that's a lot of NAIM members have the same approach. In when the tide is up, and out when the tide is down. Great. So where can we learn more about you? Do you have any interviews coming up, or do you have a website? And once again, what's the symbol for your ETF?
Yeah. So the ETF is VWI. So we have a website. It's actually it redirects as VWIETF.com. So that lands us to the Arch Indices page. So we have insights on there. We also have some analytics that we actually built out. So you can see that as well too. It lets people back test portfolios, play around, so forth. It's very basic at the moment, but we're going to introduce some AI features into that down the road. So that's kind of our base platform there. And yeah, I'll be next Wednesday at 9:50 a.m. I will be on FinTech TV, which is a network I think that is launched with the support of the New York Stock Exchange. We're listed on NYSE, so they were kind enough to invite me on for their weekly ETF segment, and we'll dive a little bit more specifically into the VWI income ETF.
Okay, great. So once again, that's VWI, volatility weighted income. Is that right?
That is right.
Volatility weighted income. Great. Thanks, Yang. Thanks for joining us this week, and thanks everyone for watching. And tune in next